Good morning everyone, I'm Luca Dell'Anna and today I will talk to you about ergodicity applied to investing. Ergodicity is a very complex term that describes a set of very simple and practical concepts that have to do with how the payoffs of decisions and strategies scale across time and other dimensions. Let me give you a very simple example. Imagine that there is an asset which has a 10% average returns every year. And imagine that today you buy this asset with the intention of keeping it for 10 years. After 10 years, what do you expect to have? Probably you expect to have cumulated returns for an average compounded of 10% yearly. However, that is probably wrong. You will probably have less than that. And even imagining 0% taxes, 0% management fees, and so on. The reason has to do with volatility, irreversibility, and other problems of which I will talk to you today. Since some of these concepts are quite counterintuitive, let me allow to start with a story, the story of my cousin, professional skier. My cousin was born in a French town on the Alps, the mountains, and even in kindergarten, children there are already put on skis to learn faster. My cousin was very talented, he made it to the World Cups, and then sadly, in his late teens, one leg injury after the other, and he had to prematurely end his career as a professional skier. From him, I learned a few things. One is that it's not the fastest skier which wins the ski championship, but it's the fastest one of those who survive. And I'm not just making the banal point that survival matters for performance. Instead, I'm saying that survival is more important than performance. And since this might be a bit counterintuitive, let me show you a numerical example. Imagine that there is a ski championship made of 10 races. And imagine that my cousin, very talented, he has a 20% chance of winning each race. However, since he also takes a lot of risk, he has a 20% chance of breaking his leg in each race. So my question for you is, after the 10 races of the championship, how many wins is my cousin expected to make during the championship? The naive answer is 2 races, is 2 wins. And the reason is because people think in this championship there are 10 races and my cousin has a 20% chance of winning each, and 10 races times 20% makes 2 expected wins. However, if we run the numbers, we discover that the real number of expected wins is only 0.71, less than half the expected win, the expected 2 wins. Why only 0.71 wins? The reason is because during the first race, it's true that my cousin has a 20% chance of winning it, and therefore that contributes for 0.2 expected wins. However, the second race, my cousin has a 20% chance of winning it, but only an 80% chance of participating, because there is a 20% chance that he breaks his leg in the previous race, and therefore he cannot participate to subsequent ones. So the expected wins contribution from the second race is only 0.2 times 80%, which makes 0.16. The third race, my cousin has even fewer chances of participating to it, and therefore even fewer expected wins coming out of it. And if we run the numbers, as you can see in the table, the expected wins from each race become lower and lower, and the grand total is only 0.71. So this is to show how important is survival for performance. Because even though in theory you have high performance, without survival you will not be able to grab the fruits of this performance. Now, so far I made the point that survival matters to performance. Let me show when it matters even more than performance. And we can make a second example comparing 2 skiers this time. One skier is my cousin, which is very performant but also takes a lot of risks. And the second skier goes a bit more slower, has fewer chances of winning each race, but also takes less risks. And we compare them here. On the left side there is my cousin. In this case, let's assume that he has an average chance of winning each race 20%, and he has a 10% chance of breaking his leg. And on the right side of the table, we can see a more conservative skier which has only a 1% chance of breaking his leg in each race. However, he goes also slower and he has a 50% chance of winning each race, lower than my cousin's 20%. If we run the numbers on the last column of each half of the table, you can see the cumulative expected wins. And as you can see on the first row, so after one race, my cousin, left skier, he has an 0.18 expected wins. And on the right side, the conservative skier, he has only a 0.15 expected wins. So it seems like taking risks is the better strategy. That is also true for the second, third, fourth, and fifth row. You get more expected wins from the risk-taking strategy. However, starting with the sixth row onwards, the conservative strategy starts yielding more cumulative wins. So there are two takeaways from that. The first one is that you cannot compare two strategies without also setting time horizons. So here, it's not that the first strategy is better than the second strategy or the other way around. What we see here is that for time horizons of 5 races or shorter, the first strategy is better, and for time horizons of 6 races or more, the second strategy is better. So every time we compare strategies, we must also choose over which time horizon we are comparing them. And then the second takeaway is that given a strategy, its payoffs, its average payoffs depend on time horizon. If we take the first strategy, for example, the one to the left, the more risk-taking one, the expected payoffs of that strategy after one race is an average of 0.18 wins per race. After 2 races, it goes down to 0.34 divided 2, that's 0.17 cumulative win per races. After 3 races, it's 0.49 divided 3, which is even less than 0.17. After 10 races, we can see that it's a 0.117. So you can see how the average expected wins per race changes over time, even though the strategy is the same, because of the effect that irreversible losses, such as breaking your leg, absorb future gain. So the big takeaway for investing is every time that you hear someone, a financial investor, for example, that tells you that this investment strategy has this % returns every year, you should always ask him over which time horizon. And if he says it's always the same every year, I would very much doubt that. Every time that you have a chance for some irreversibility, for example, part of your investment, one of your investments going bankrupt, you needing money for any reason, for medical expenses, for example, and needing to withdraw some money from the investment, anything that can make a loss irreversible will cause average returns to depend on the time horizon. So that was it for the first third of today's talk. We saw the relationship between survival and performance, and in particular that performance is always linked to survival, it's subordinate to survival, and how much survival impacts performance depends on the time horizon. The longer the time horizon, the more performance will depend on survival. Now in the second third of today's talk, I will talk about the effects of luck, and in particular of luck compared to skill. And then in the third part of today's talk, I will give you some practical and concrete tips on how to get more reliable investments and how to make them grow faster over time. Before that, just a short disclaimer: I'm not a financial professional. Nothing that you hear here is financial advice or advice of any other kind. These are just considerations that come out from the study of ergodicity. Now let's talk about skill, luck, and how each influence performance. And let's begin with a thought experiment. Imagine taking 100 investors of different levels of skill, but all with the same starting conditions. They all start with the same wealth, with the same connection, with the same access to investments, and so on. So they are all in the same conditions, they only change for their skill, and we follow how their wealth evolves over 10 years. And if we come back after 10 years, we will see that they each have wildly varying wealths. But we would also notice, counterintuitively, that the richest of all these 100 investors will probably not be the one which has also the most skill. Don't get me wrong, the one with the most skill will probably still be quite wealthy compared to the other investors, but probably will not be the wealthiest of them all. And the reason is because there is only one investor which has the most skill of everyone else, but there are, for example, 10 investors which are very skilled nevertheless. And of those 10 investors, the chance is that there is one that got very lucky and therefore whose investments outperformed the ones of the most skilled person. So this is the effect, an effect that we see everywhere in life. If you want to have great performance, usually having great skill is enough. But if you want to be number one, you also need to have great luck. Because even if you are the most skilled person, the chances are that you will be outperformed by someone who is somehow skilled but also got very lucky and or took extreme risks. So the temptation would be, even if you have a very high skill, would be if you aim for the number one spot to also take extreme risks so that you have a shot to be number one. However, if you do take extreme risks or you choose a strategy that is based on luck, the chances are that you will end up worse off than if you chose a more conservative strategy, one that purely leverages your skills. So we all have this trade-off in our lives. On one side, we want to be number one. So we have this pressure to take risks. However, the more we take risks, the more we lower our average outcomes, or at least our median outcomes. We lower our distribution of outcomes. So my advice for you would be to consider whether you really want to aim for number one and whether it's worth the downsides. And also, whenever you spot someone who is a number one, know that there is some survivorship bias, and over, for example, 10 parallel universes, only in one he's number one, and in many other universes probably end up in not such a good situation. Because if you think about it, in 10 universes, probably if you take a risk, if you are very skilled and you take a strategy which doesn't take too many risks, over 10 parallel universes, probably you will not be number one. Maybe across your friends or colleagues, you will be number 2, number 5, something like that. There will be someone else which is number one. However, and this is critical, over 10 parallel universes, it will always be someone else with number one, a different person. It's very unlikely that it will be the same person number one over universes, because the way they got to number one was by taking risks, and that affects the distribution of outcomes negatively. Now, I do realize that some of these might be counterintuitive. So, I will show you in the third part of today's talk how the distribution of outcomes gets affected by some strategies, for example, rebalancing. So earlier I promised that during the third and final part of today's talk, I will give you some strategies on how to improve the reliability and the performance of your investments. And in particular, today I want to talk about rebalancing. And first I will make an example that has to do not with investing but with gambling, and then I will make a second example which has more to do with investing. So let's begin with the example of a gamble. And let's think about this gamble in which I give you a basketball, and the gamble works like this. You start taking free throws, and if you hit, you double your wealth. And if you miss, every time you miss, you halve your wealth. And let's imagine that you start with $100, and let's assume that you are an average free throw shooter with a 50% chance of hitting and 50% chance of missing every time you shoot. So let's make an example. First shot, you hit, and you double your money from $100 to $200. Second shot, you miss, and you halve your money. From $200, you go back to $100. Third shot, you hit, and from 100 you go back to you go up to $200. You double your wealth again. Now this is pretty simple. But now let's introduce another variable, and let's imagine that this time you have the option to rebalance. And in particular, in the second example, you will play basketball, you will play this gamble together with a friend of yours. The rules are exactly the same. Every time each of you shoots, if they make the shot, they double their own money, and if they miss the shot, they halve their own money. However, in the second example, after each time that you and your friend take a shot, you will pull together your wealth and you will split it 50-50. Let's imagine that your friend is just as skilled as you, 50% chance of hitting and 50% chance of missing, and let's see what happens in this scenario. First shot, you hit again, like in the first example, and you double your money from $100 to $200. Your friend instead misses, and from $100, he halves his money to $50. Now the rebalancing takes place. You pull together your wealth, 200 plus 50 makes $250, and you split it 50-50. And each of you has $125. Now, compare this with the first situation. In the first example, after one hit and one miss, you went back to $100. In the second example with rebalancing, one hit and one miss, and now your wealth grew from $100 to $125. But let's continue. Second shot, as in the first example, you miss. So from $125, you go down to $62.50. Conversely, your friend hits the target this time, and he doubles his money from $125 to $250. Now again, you pull your wealth, 62.5 plus $250 makes $312.50. You split it 50-50, it's $156.25 each. Now, just as in the first example, you made one hit and one miss, and also your friend made one hit and one miss. But this time, thanks to the distribution, instead of being back to $100, you grew to $156. That's amazing, isn't it? And that's the power of rebalancing and redistribution. It reduces the reversibility of losses so that they absorb fewer of the future gains in the future. So this is something that in general could be considered a good idea, is to rebalance between your investments or your sources of wealth, your assets. This is also true, up to a certain limit of course, if you rebalance from something which is high performing to something which is lower performing. Of course, if you, for example, you're playing basketball and the other person is a terrible shooter and he has only a 5% chance of hitting the basket instead of 50%, then maybe it's better not to redistribute. But if your friend is just slightly less good than you at shooting the basketball, probably it's better to redistribute for you. Selfishly, it's better to redistribute, even if you're redistributing with someone who is slightly worse than you. Now, let me show you this with a numerical example that has to do with investing. I've created a very simple model here. I won't go too deeply in it because I already shot another video which goes much more in detail of this model. It explains its assumptions and it's much more detailed. I will link to it in the description of this video. But just here the summary and the takeaway. In this model, I'm comparing two investment strategies. The first one, the left column, is in which you're putting all your wealth into a very high-performing asset, which is also very volatile. And in the second strategy, you're splitting your wealth 50-50, 50% in the high-performing, high-volatility stock as before, and 50% in a portfolio which is much more conservative, has lower returns, but also lower volatility. And every year, you put together your two investments, the 50% which is in the high-performing stock and the 50% which is in the lower-performing portfolio. You pull them together and you split them 50-50. So every year you're rebalancing. And then I've created, in this model, it's just generating random numbers based on the initial assumptions, and we can follow on the right side how the two strategies evolve over time. And for example, in this one scenario with the one set of randomly generated numbers that you can see in the table in the table here, the right strategy, the second strategy, so the one in which I rebalance, had a higher compounding growth, the one that you can see in the first row. Of course, this is just a coincidence because I just randomly generated one scenario, one set of numbers. So what we should do to be more rigorous is to simulate multiple scenarios multiple times, doing a bit almost of a Monte Carlo simulation, and see not the average outcome over all these scenarios, but we are more interested about the distribution of outcomes across all these scenarios, which will almost be like parallel worlds. Like today you take an investment decision, and then you want to see how that investment decision pans out over multiple different worlds in the future years. And here we get a zoom out on the distribution of outcomes, in this case across 20 randomly generated scenarios. And you can see in the line, in the third line, the best scenario, we can see that the best single outcome is in the left column, which is the one in which I concentrate all my wealth into the high-performing investment. And that's what I was telling you before. Usually, the number one is the one which take a bit more risks with the decisions. However, look at the following lines. The top 10%, the top 25%, top 25% is already like starting to favor the second strategy, the one with rebalancing. Look down at the median. We can see that the median is better, the median scenario, the median outcome is better if you rebalance. And then look at the single worst outcome. This line, you can see that the worst outcome in the high risk strategy is that you lose almost all your money. Whereas conversely, the worst scenario in the rebalancing strategy is still quite a respectable 7%. So again, this of course is not investment advice, it's not financial advice. This is a limited simulation in which I'm just randomly generating a few scenarios and seeing what happens. But as you see in the full video as you can see in the full video on this model, if you keep generating 20 more scenarios, 20 more scenarios, 20 more scenarios, you can see that the pattern is almost always this one. The single best outcome, the number one outcome, is in the risk-taking strategy, but better not to pursue it because the distribution of outcomes is better in the strategy with rebalancing. So the takeaway for today is whenever you consider an investment, a strategy, or even just a decision in life, never just look at an average, but always look at an average or considering a time horizon. And secondly, more important, is do not look even at the average, but look at the distribution of outcomes. Because at the end, you do not really care about the average. What you care about is the distribution of outcome. You care, are there some worlds, some parallel worlds in which this investment strategy, even though it has a high average outcome, it actually leaves me in a very poor situation. And maybe you want to reduce this. Maybe for you the best strategy is not the one which has the highest average returns, but it's the one in which almost all scenarios you do not end up in a poor situation. Maybe the strategy in which in almost all scenarios you end up pretty well nevertheless. So thank you very much. This was a short talk on ergodicity applied to investing. There is much more in the book that I wrote about ergodicity, which you can find on Amazon in paperback, on my website in digital form. It's simply called Ergodicity by Luca Dell'Anna, and you will also find the links to the book below. Thank you very much. And last thing, I also organize personalized one-on-one sessions if you want to understand better ergodicity or how ergodicity could apply to your investments, to your life decisions, or to your companies. And I also organize lunch and learn education sessions for companies and organizations in which I can explain in a very simple and practical way what's ergodicity and how it can apply to decision making in the organization and in their lives. Thank you very much.